So I wanted to, again, welcome everyone. We're going to be talking about looking forward in 2023, a bit of a quick overview of 2022 and talking about both investments and personal finance matters looking into 2023. I think hopefully many of you know who we are and what we do, but just as a brief overview, SageVest Wealth Management is a wealth management firm, as denoted in our name, which means that we work with individuals and families on wealth management matters, which entail managing investments on behalf of clients, but looking at the totality of their financial decision making. And how one decision affects the other to make sure that everyone is making wise financial decisions and for benefit of their future. Before I really kind of kick off, we'll work through this presentation, but we do welcome your questions throughout. So please feel free to use the Q&A section on the webinar to post any questions that you'd like us to address. We'll try to answer them in current time, unless there's a number of questions and we need to hold off until the end in the interest of time. All right, so without further ado, I'll get us moving here. First, we'll go through and just introduce ourselves. We have 4 different advisors on our team presenting today. Myself, Jennifer Myers, president of SageVest Wealth Management, and I'll let everyone else run through and introduce themselves.
Perfect. Thanks, Jennifer. So Brian Albritton, I'm a certified financial planner advisor here with SageVest. Appreciate everybody joining us this afternoon.
Hi, welcome everyone. I'm Dan Saris, CFP and Senior Financial Advisor here at SageVest.
Hello, everyone. My name is Anthony Matteo. I'm a certified financial planner and also a financial advisor here at SageVest Wealth Management. We appreciate you all taking the time today to join us, and we hope you take something beneficial from the webinar. Without further ado, I'll hand it back to Jennifer to kick us off.
Thank you, Anthony. So just as a quick overview of what we're going to be talking about today, we're going to touch on a number of points. First, investment considerations, looking back into 2022, and then some sort of hot topics. Inflation remains a hot topic in the investment world and the economy, so we'll definitely speak about that, as well as bond yields after a very difficult year in bonds last year, but thankfully, some more positive notes moving into 2023, which are definitely worthy of consideration and discussion. We'll also talk about some tax changes in the realm of retirement planning. New contribution limits to retirement plans that everyone who's currently has current earnings should be aware of going into the new year. Discussion about inherited IRAs with some proactive planning considerations that are important today. And finally, again, on the topic of taxes, some energy tax credits that are available in 2023. So moving forward, again, we'll start with investments and looking historically and forward. As I mentioned, it was not a pretty year in 2022 for the investment markets. It was a very unfortunate year where basically there was no place to hide in the markets. Both bonds and stocks were abnormally down for the year. This gives an overview of the primary benchmarks for primary segments of the market. So first, we talk about bonds. The Bloomberg Aggregate Bond Index was down about 13% for the year, which unfortunately set a new record low for bonds over the past more than 100 years. The S&P 500 index, which everyone is probably aware of and talked about predominantly in stocks, was down about 18%. The NASDAQ, which is heavy in technology and growth stocks, took a real beating last year, down about 32.5%. Also, the Russell 2000 small cap stocks down about 20%. And international stocks definitely down, but not to the same magnitude at about 16%, which we'll talk about was a reversal last year in terms of performance among domestic and international stocks. One of the things we talk about with clients is the fact that we do not try to time the markets. Study after study shows that it's a dangerous way to approach investing. And we outlined here some of the primary, larger investment firms and what their forecasts were going into 2022 for the S&P 500 performance. So what this chart does is look at, in the middle column, what each firm, Oppenheimer, Credit Suisse, JP Morgan, et cetera, prognosticated for the year, and then the percentage that they were off relative to the actual performance. The actual performance was that the S&P ended at about 3,800. No one predicted that type of depth decline in the market. So again, reason why we don't try to forecast the markets. We'll talk about things looking into 2023, but not predictions. As I mentioned, there were a number of reversals in 2022, which we think are important to discuss. For a long-standing period of time, there were three themes: that technology was raging, that the value side of investing, which is more dividend-paying type companies, that value investing was dead, and that international was never going to thrive again and was the wrong place to be. Each of those reversed last year. Technology darlings became the technology duds in 2022, which we'll talk about. Value did extremely well, coming back into vogue. And as we discussed on the prior slide, international stocks, they were down last year, but they did outpace the S&P 500, and they're currently outpacing in 2023. These charts help to demonstrate what you see here on the left top chart is that 2021 growth definitely outperformed relative to value, growth being up 32%, value being up a lesser amount of close to 25%. Dramatic reversal in 2022, where technology growth stocks in general were down 29.4%, whereas the value side of the equation and more of a value benchmark was down, but by a much lesser degree at about down 5%. We also think it's important to note that there has been sort of the so-called FANG stocks, which are Facebook, truly now owned by Meta, but Facebook, Amazon, Apple, Netflix, and Google, hence the FANG, really took a beating last year. Facebook down 64%, Amazon down 49%, Apple down 26%, Netflix down 51%, Google down 39%, and we decided to throw in Tesla because it also took a pretty significant dive, down 65%. So distinctly a reversal in the performance of growth-oriented stocks. This chart looks at that reversal that we talked about in international stocks. And part of the reason why we have seen a reversal is international stocks are pretty heavily linked to where the dollar is. And when the dollar is higher, it puts negative pressure on international stocks in terms of the currency exchange. Last year, we saw a dramatic increase in the dollar, but that started to reverse in the fourth quarter. So you'll see here in the orange, it shows the value of the dollar index last year, which you can see started to decline in the fourth quarter. And that corresponds, it's almost an inverse mirror image in terms of purple being the return of the international index and showing that international stocks staged a pretty significant rally at year end. So with that, we'll start looking more into the current year and some considerations, and I'll transfer this over to Ryan to take us further.
Excellent, thank you. So again, looking forward, as Jennifer mentioned, we do see some positive signs. There are still reasons for concern as well. We always want to make sure we're aware of that. but outlining some positive signals. So inflation does appear to be fading, and we'll look at some of that in some of the following slides. Fixed income is looking brighter. You can actually get yields off of your bonds now. Inflation receding, expected that the Fed's interest rate hikes might moderate. We will see if that is the case. Fed's actually meeting again tomorrow. And we'll just start to see if they moderate and then potentially pause in the future. Labor force. So the labor force data suggests we're not in a recession. The US labor market is very strong. Unemployment remains low. Some reasons for concern: inflation is still stubbornly high. So while we've seen it fade some, it is still at levels that would likely be unsustainable, and really highlighted by services rather than goods. Early in COVID, goods were the driving factor of inflation. People were ordering things, and of late, it's shifted to services. It's shifted to people vacationing, people going out to dinners, things of that nature. And the yield curve is inverted, basically meaning that long-term interest rates are less than short-term interest rates, which is sometimes an indication of a potential recession, but we'll have to see if that is coming. And then the impact of China ending their zero COVID policies and how that impacts the global economy. So again, inflation is remaining high, but this chart is to show that it does appear to be fading. So it looks like we actually topped out in June of 2022 with headline CPI at 9%. And then you can see as we've moved to the right towards the end of 2022 in December, had dropped down to 6.4%. So it does appear to show that we are decreasing, but again, want to see that continue. Going back to the outlook for fixed income returns in 2023. So as I mentioned earlier, you can actually get some yield off of your bonds now. So this is showing developed market 10-year bond yields for the United States, Canada, Germany, so on. And if you see the blue dot, that's where yields were in December of 2021. As you can see, yields have increased significantly from that point, with US at 3.88%. And then you can see across the board, we've had pretty significant increases off of those low yields that we were seeing back in 2021, with some even being negative at that point. As Jennifer mentioned earlier, it was an incredibly difficult year for bonds in 2022. But we did see some positive signs late in the year. So what this chart shows is looking back at October of 2022 to January of 2023. And we can see that bonds have actually increased 7.6% as weighted by the Bloomberg US Aggregate Bond Index. So a positive sign. We hope to see continuation, but certainly a good direction, and nice to see some reversal there.
And I'll just chime in on that note that, it was definitely looking scary in bonds as they were down even further than the 13% where they ended the year. Part of why we don't time the markets or, react when investments are at losses, deep losses is, this really demonstrates that had you moved out of bonds at the depths of the market and even moved into a treasury yielding about 4%, you would have missed out on more than a 7% rally.
Yeah, that's a very important point. In this chart, we're looking at stocks versus bonds. And really the takeaway here is that the majority of the time, stocks and bonds on a monthly basis are positive. So this looks back all the way to January of 1976 through December of 2022, with stocks being represented by the S&P 500, bonds being the Bloomberg US Aggregate Bond Index. And what we can see is that again, on a monthly basis, dating all the way back to 1976, stocks are positive 64% of the time. Bonds are positive 67% of the time. And looking to annualized returns, again, dating back to 1976, stocks 11.4% and bonds 6.6%. So with that, I'm going to hand it over to Dan to take us from here.
Thanks, Ryan. Hello, everyone, and welcome. Let's jump into what's some changes that are looking ahead for your retirement planning. While you were enjoying the holidays at the end of last year, Congress was busy making some changes to your retirement. The big one they made is pushing back the date for required minimum distributions from your IRA, 401k, and other retirement plans to age 73. Used to be 72, before that 70 and a half, but now from now on, everybody is going to start at 73. And if you're born in 1960 or later, that's actually going to be 75. So they continue to push that back. Those who have started their RMDs last year or before will continue as normal, but we will have some changes going forward for those who have not started yet. They've got a little more time. And the implications of that, as you see, we noted here, is because the window for your RMDs is a little smaller. You know, before, if you were going from like 70 to 90, you had those 20 years, and between delaying the withdrawals and a shorter life expectancy, those RMDs are likely to be larger as they remain invested and hopefully continue to grow before you have to start taking them out. So this is creating some opportunities that we're looking at for Roth conversions before you start your RMDs, because that will lower that amount of RMD. Because if you are delaying and don't take anything out, as I said, that first point, your RMDs could be higher, and that would mean a higher tax bracket potentially for some people. So that's something that we like to watch carefully, any opportunities for a Roth conversion before you start, and just potential elective distributions before RMDs start, because that you may still be able to get some money out at a lower bracket. So with all IRAs, you know, the goal is getting as much out as you can at the lower brackets. So it's going to be a lot more tax planning with IRAs going forward.
That's something we really try to look at with clients on a very proactive basis at year end, looking through tax planning and distinctly looking for those opportunities. So hence why we always ask for your tax returns and check in on different matters.
Exactly. There's a few other changes to note from Secure 2.0. Congress is being a little more generous with the Roth accounts. If you have a Roth 401k at your employer, there's no longer requiring an RMD in that. That was one of the holdouts of the Roth, all the Roth accounts that did require an RMD, but now in 2024, you won't be required to take money out of the Roth option. They lowered the penalty for if you missed your RMD for the year down to 25%. 10% have been corrected in a timely manner. Of course, that's not clearly defined yet, but most likely it's like within a month or two after the end of the year, if you correct that, you should have a lower penalty. Charitable contributions through your IRA remain in place with the QCD, and those will stay at 70.5. So even though your RMD is pushed back to 73 or 75, you can start making charitable contributions from the IRA at 70.5. They also put out a list of a various amount of conditions where you can take early withdrawals from your retirement plan without penalty under certain circumstances. So it's important, as I say there, to keep us updated on any circumstances in your life. The retirement accounts may become more of a resource because they're allowing some conditions to withdraw those without penalty. So there's, like, as I mentioned, there are 80 more others that are just really fine tuning and retirement planning. Again, keeping your advisor updated on changes, we can see if any of those apply to you in the future. And this finally next, some key changes in those who are still saving for retirement. The catch-up contribution for your IRA of $1,000 is going to be indexed for inflation. So instead of continuing to go up at $1,000 a year, they're going to start doing an inflation amount. So you can, in the future, start contributing more to your IRA if you're over 50. And then one little bonus for those who are going to be 60 to 63, starting in 2025. You can make a larger catch-up contribution to 401ks at $10,000. That's also going to be indexed to inflation. And individual owners with solo 401ks or those starting them, they can now be open and funded by the tax filing deadline. Before it was, you had to open and contribute by the end of the tax year. Now they're letting that go all the way until you file the taxes. The simple and SEPs are now allowing Roth contributions, and all employer plans are going to be allowed to match your contributions on a Roth basis instead of the previous pre-tax situation. So employers, if they have a Roth option, they have to be able to offer this for it to happen, that they can match. So in a sense, you can now put all of your employer plans into a Roth account. One caveat to note, important there on the right in the blue, that if those people with wages of more than 145,000, starting in 2024, those catch-up contributions we just looked at have to be made in a Roth plan. So this is going to reduce the ability to defer taxes. Like for example, the catch-up right now for the 401k at 50 plus 7,500. So you were before able to defer that on the pre-tax. Well, now you're going to have to do it as a Roth option, so you won't be able to deduct that. So there'll be a limited ability to defer taxes because the Roth 401k is going to be required if you make that certain wage amount. So you can see here there's a lot of things Congress worked on by opening the Roth more to people. Again, reason they want their money now, they want you to contribute to your retirement, but they don't want people to keep pushing back the taxes on that. They want the money now. So we're seeing the Roth be a little more friendlier vehicle to Congress. People have asked, are they ever going to do away with the Roth? And this symbol here is like, doesn't look likely that this Roth is going to be around as a tool for Congress when they balance the budget. And speaking of that, next, there's one little thing. If you are having any kids or grandkids saving for college, or you're graduated and have student loan payments, there's a few notes here for you. If you have any money left over in a 529 plan, once your child or grandchild is completed, starting in 2024, you can use those funds to fund their Roth IRA. So currently, the limit is 6,500. You can start using up to 35,000 over, whatever time period that is, about 5 years. You could probably fund the student's Roth IRA if they're eligible. So that's a nice little bonus for people who are worried about losing money because they can't get out of their 529. You can just use that in the future to fund the child's Roth IRA. Just note that the Roth IRA, or the 529, must have been open for 15 years or longer, and any contributions made in the past 5 years before this starts are not eligible. For younger workers who are making student loan payments, Congress is allowing employers to match those loan payments by making a amount equal to those payments into the employee's 401k. So it's sort of a way of helping students who have graduated with debt and don't have enough money left over to fund their 401k. The employer can actually help them out a bit by matching, still doing a contribution up to that loan payment. So the young worker can start saving earlier. Note that this is a benefit, it's not a requirement, so employers have to offer this. It's not something that's automatic. The employer has to offer this as a benefit. And next, there's some adjustments going forward that I'll let Anthony tell us what we can start doing now with our retirement plans.
Thanks, Dan. Appreciate it. There was a great overview of all the changes that have come about with Congress passing of Secure 2.0. As Dan mentioned, we're going to talk here about some contribution limits entering the new year. And as it says at the top, new year, new limits. And you'll see increases mostly across the board. For your 401k accounts, also 403bs, most 457s, and your TSP plan if you have one, the 2023 contribution limit has seen a significant increase to $22,500. That's an increase from $20,500, so $2,000 increase. If you're over 50, age 50 plus, the catch-up contribution limit for 2023 is $7,500. Again, that's a $1,000 increase from last year. The limit was $6,500. So altogether, if you're age 50 plus and working and have a 401k plan, you can contribute up to $30,000 this year. That's an increase of $3,000 from last year. And it could be significant going forward as you move through your working years and prepare for retirement. Important note here is, with these increases, we just want to make sure that everyone, if they are able to max out their 401k plan or other retirement account plan, that they go in and make the contribution changes for your, per pay period contribution. You'll have to increase it from last year to ensure that you're hitting the max by the end of the year. Not only have 401ks seen a contribution increase limit, but simple IRAs, and Roth IRAs and HSAs. I'll point out the IRA and Roth IRA contribution limit. That is up to $6,500 in 2023. That is an increase of $500 from last year, which was $6,000. The age 50 plus catch-up contribution remains unchanged for IRAs and Roth IRAs. That is still $1,000. But as Dan mentioned, one of the changes from Secure 2.0 is that starting in 2024, that $1,000 catch-up contribution limit will be indexed for inflation. So increases to the contribution amounts for those accounts are coming here in the near future. Roth IRAs, not anyone can contribute to the Roth IRA. There are income phase-out limits, but with the increased limits in 2023, there are also increases to the income phase-outs. So you may be able to, you may have not been eligible to contribute last year, but with the increased limits this year, you may become eligible. HSAs, or health savings accounts, are a great savings tool for tax-deferred growth on potential healthcare to be used for healthcare expenses. If you have a high deductible healthcare plan, HSAs are a great tool to use and implement in your savings plan. The 2023 contribution limit has increased for both self-only plans and family plans. Both limits were increased by a couple $100s each. If you're age 55 or over, you're able to include a catch-up contribution of $1,000 that remains unchanged from 2022.
I'll just make two extra comments here that first, even if you're retired and these don't apply to you, these might be worthy of sharing with adult children who are in the workforce, because sometimes it's uncomfortable to talk about money. And if your kids are on track, but sometimes it's easy to provide a presentation and just to share some knowledge that's presented to you. Secondly, if you are contributing to any 401k, 403b, any retirement plans that you receive matching contributions, one thing that we always want to recommend is that you spread those contributions throughout the year versus lumping them early or later in the year. The reason being is that if you lump them and do not spread them, you may not capture all of the matching contributions that you could, which is basically leaving free money on the table if you're not getting all of the employer match.
Absolutely, that is a great tip, Jen. So now we're going to shift into a rundown of inherited IRAs and the importance of proactive planning. So this slide, we're going to focus on post-2020 inherited IRAs. So Dan just recently, talked about Secure 2.0. Secure 1.0 was enacted in December of 2019, and it included one of the largest retirement plan changes in history. And to be honest with you, the magnitude of this change was likely larger than any of the changes that have come about with Secure 2.0. And what that was basically, it ended, for most instances, the stretch IRA. So if you inherited an IRA before 2020, so 2019 or before, for most beneficiaries, you were able to stretch the distributions that were made on that inherited IRA throughout your lifetime, and the tax impact was not as tax punitive as they are now. With Secure 1.0, they truncated the distribution time frame for a majority of inherited IRAs to 10 years. Simply put, inheriting an IRA, a retirement account, is more tax punitive now than ever before. And ultimately, that makes it more important to understand the rules behind your inherited IRA and the distribution rules associated with it, and to put in place a plan and be proactive about it to ensure that you are minimizing the taxes that you are paying and maximizing the wealth that you were able to transfer. So this chart on this page talks a little bit, tries to give us a rundown of the 10-year distribution rule. And if you inherit an IRA in 2020 or beyond, so in the last 3 years or going forward, if the owner of that IRA was already RMD age and taking required distributions, you'll likely have to distribute the full account balance within 10 years. And you will have to continue an annual required distribution amount. You'll see an asterisk in that box. The last 3 years, these RMDs have been waived. In 2020, due to the CARES Act, which was the COVID Relief Act that was passed. And then in 2021 and 2022, the IRS waived the RMDs on these types of accounts because there was basically a transition period where the IRS and planners and attorneys and et cetera were determining the actual language of the bill and how to interpret that language. Going forward, 2023 and beyond, we expect those RMDs required amounts to be required. The second row here talks about if you inherited an IRA after 2020, but the decedent, the owner of the IRA, was not RMD age and was not yet taking RMDs. You again will have 10 years to distribute the full account balance as a beneficiary, but you will not be required to take an annual distribution amount. Therefore, it'll be even more important to determine when, how much, and in what pattern you will take these distributions out. There are exceptions to this 10-year distribution rule. If you inherit an IRA retirement plan from your spouse, you'll likely be able to stretch it throughout your lifetime, and you will not be truncated to 10 years. If you're a minor and you inherit an IRA post-2020, you'll likely potentially be able to increase that 10-year period. The 10-year period will likely start once you hit the age of majority, which generally is around 21. If you're disabled or chronically ill, you likely will not have, you'll have longer than 10 years to distribute the account. Or if you inherit a retirement plan from someone that is not more than 10 years older than you. So you're less than 10 years younger than the decedent. So as you can see, with these changes, it's more important than ever to be proactive in our planning. And what does that mean? There are a number of planning moves that you can make during your lifetime. If you own a retirement account and you know you have a large IRA, a large 401k that eventually will go to your beneficiaries, or if you know that you are the beneficiary of an IRA, or you have just inherited an IRA, there are important proactive planning decisions to make, over those next 10 years or the years leading up to when you inherit that IRA. First, I want to touch on what decisions you can make during your lifetime as an IRA owner, knowing that you're going to be passing IRA assets to your ultimate beneficiary or recipient of those monies. It is very important to review your estate planning documents, review your beneficiaries on your retirement accounts. If you have a trust structure in your estate planning and the beneficiary of your IRA eventually goes to a trust, it's important that the wording and the language in the trust does not disqualify the beneficiary from that 10-year time frame. There's certain wording that may truncate that 10-year period to a 5-year period. You'd also want to review if you have charitable, if you have charities as remainderment beneficiaries, to ensure that the language in the trust or the language of passing those monies to the charity is does not, again, disqualify the 10-year rule and truncate to a 5-year rule. Simply put, review your estate planning documents, work with your advisor, work with your estate planning attorney, be proactive about it, and make any changes if there need to be changes made. Secondly, another lifetime decision that can be made is Roth IRA conversions. Dan talked about it a little bit, with the RMD age increasing. Another reason that Roth IRA conversions have come to the forefront of planning is the tax punitive, the large tax impact on the beneficiaries if they inherit an IRA. With this 10-year distribution period, all the distributions are ordinary income, taxes ordinary income. Hence, you may want to make Roth conversions in lower tax bracket years before you start your RMDs. If you retire, have a span of low income years, you potentially want to take those monies out of the IRA, convert it to a Roth IRA, pay taxes now at the lower bracket, not only help yourself later in retirement, but potentially help your beneficiaries. Secondly, to that point, it may be beneficial to make Roth IRA conversions if you are in a lower tax bracket than you think your beneficiaries may be during their lifetime when they inherit those monies and have to take out the money within 10 years. So it's, again, another potential opportunity, lifetime decision to be proactive and help create and maximize long-term family wealth transfer. Lastly, we want to touch on family charitable giving decisions, QCDs, so contributions from your retirement accounts that you can start at age 70 and a half. You can contribute directly to charities up to $100,000 at this point due to tax law. It may be beneficial to think about doing QCDs rather than gifts directly to charity. We've also seen strategies that work that it may be beneficial if the parents have the ability to make gifts on behalf of their children who are set to inherit these monies, and make gifts on behalf of their children's desires and to charities that their children may want, to again decrease the IRA balance and again increase long-term wealth transfer. Then if you inherit an IRA, there are a number of proactive planning tools to use to review. You're likely going to have to distribute these funds within 10 years. And so there's a lot of proactive planning to be done to look at your projected income, to look at the taxes and try to minimize those taxes based on the timing of distributions and when you take out and how much you take out from that IRA. Again, charitable giving decisions are also important. In a high income year, if you have to take out distributions from your inherited IRA, you may, and if you have charitable intentions, you may want to up your charitable giving that year. Charitable giving is a great way to decrease taxes.
Thanks, Anthony. And I'll just add, working with individuals, all of these considerations are one that we look through relative to your current year tax considerations, future year tax considerations, and as part of, the ultimate family wealth transfer potential.
All righty. Well, that was quite the overview on inherited IRAs and the importance of proactive planning. I'm going to hand it back over to Dan to discuss some of the improved tax benefits for clean energy and efficiency that was enacted and enhanced through the Inflation Reduction Act in August of 2022.
Thanks, Anthony. Yeah, Congress also gave us a little more incentive for those who want to help the environment and have some more energy efficiency in their daily lives. One of the first things they've done this year is the energy efficient home improvement credit. You can see there's an up to a 30% tax credit or $600 on each qualified expense. This is up from previously there was 10% tax credit. So they're increasing this incentive for people to become more energy efficient with their homes. For example, getting a door, windows, air conditioner, water heater, as long as they meet the Energy Star ratings or the qualifications. Again, the contractor you go with will have the details on whether that meets the qualifications or not. But this will provide a nice little added incentive to help offset those costs. The items must be placed in service between this year and 2033. You can get a maximum of $3,200 a year credit. And then you can do that every year. So you can make energy efficient credits every year up to that $3,200 a year. However, you cannot carry forward those tax credits. So if you do not owe, for example, if you are qualified for $3,200 tax credit, you need to owe $3,200 or more in taxes to be able to offset your taxes with that credit. And just note here that second homes are eligible for this if you own a second home, but not your rental property, but any other home you own or occupy. And then the other one that's gotten a lot of attention is the solar energy expense credits, 30% tax credit, and there's no dollar limit on this. So for example, a $50,000 solar project on your home, will get you about a $15,000 tax credit. So these can be very generous to help offset the cost of going solar. This actually started last year. So if you had any solar expenses last year, those are eligible. Again, for the next 10 years. This credit may be carried forward. So say that $15,000 you qualified for, you only owe $10,000 in taxes. The remaining $5,000 can be applied to the following year's taxes. So you can extend that beyond a year for the credits. Again, second homes are eligible, but not rental or business. And any subsidies or rebates you get from the manufacturers or local governments that'll reduce your cost. You can't take the benefit on that if your cost is low. It's actually you're out of pocket after rebates. So again, if you're interested in exploring solar energy for your home, this was a nice tax credit that's available for the next 10 years. And then finally, a lot of people have also been interested in the clean vehicle credit. Any qualified plug-in electric hybrid vehicle is eligible as long as it meets certain requirements. As you can see here, less than 14,000 pounds, 7 kilowatt or higher battery, and it has to be external charging through a plug-in. And then one of the more controversial parts of this is it has to be final assembly in the US, Canada, or Mexico. So a lot of these foreign hybrids and electric vehicles are not qualifying for this. So you need to make sure that it's a final assembly. There's dealers have lists of what cars qualify, and there's also a article on our website that has a link to, you can look up the VIN number to see if that car qualifies for the tax credit. And that tax credit is up to $7,500, $4,000 if it's a used car, and you get to claim that in the year you take delivery of the car. So if you're ordering a car that's not ready yet and it's not ready till next year, you can't get the credit till next year when you receive it. So timing is important here for that one. And also note that is a tax credit up to $7,500. It all depends on the components of the vehicle. So if some things may not qualify for certain credits, so your credit can be anywhere, from a few thousand up to that $7,500. So it's important to work with the dealer to make sure your car is eligible, for the full credit if you can get that. And this credit cannot be carried forward. So again, you have to owe $7,500 in taxes for the year to be able to offset that amount. Note that they did require some maximum prices for these vehicles. So it's not just any electric or hybrid vehicle. The car cannot have a manufacturer's suggested retail price of more than $55,000 and a van SUV truck of $80,000. This has been a little difficult because a lot of these vehicles do cost a lot more than that. However, Tesla, Ford, and Chevrolet have reduced their prices to have more cars qualify, or introducing more cars later this year under these limits. So the manufacturers are responding to this by lowering prices and introducing more vehicles under these limits. So that's helped. It's just a matter of waiting to see when they're available and when you can take delivery. And they also have used cars of $25,000 maximum price. This is mostly geared towards leased cars that are coming back after 2 years. If a dealer wants to sell one of these cars after a lease period, that you cannot buy that leased vehicle if it's more than $25,000 to get the credit. And then you have to have certain limits for your income. The modified adjusted income for you to qualify for these tax credits is $300,000 per married couple, $150,000 for a single taxpayer. So you have to come under those limits to be able to get these tax credits. And for the used vehicle, you can see a little bit lower income requirements are in place. So there's still some more, technicalities going on with this. IRS is expected to issue more guidance in March or later. So, if you're interested in this, it's a good time to start researching it and then getting with your CPA later on about what's exactly eligible for you to receive tax credits on. And I believe that's it for the tax credits and all the changes for this year. So Jennifer, I'll let you close this out today.
Sure. Thank you, everyone. First of all, we want to open this up for questions. We've reviewed a lot from tax planning to inheriting assets to planning for wealth transfers, energy tax credits. So we definitely welcome your questions as we went over a number of topics. Kathy, I'll ask, has anything come in on the Q&A, and that feature is offered on your screen to submit a question electronically to us?
No questions yet.
Okay. Well, we'll hold this open for a little time, but we definitely appreciate you joining us. If you do have any questions or personal planning considerations that you want to explore based upon these topics, we're happy to speak with you individually after this presentation. We definitely are a group that try and pride ourselves in being proactive in working with our clients. So we like to hear from you to make sure that if there is something on your mind, that we're being responsive to it and helping you to think through it, as well as proactively giving you advice that we think is germane to you.
It looks like there's one question. If you could post that in the Q&A. Someone just has their hand raised.
We're not able to allow people to speak just for privacy considerations for everyone. So if you are, as Kathy mentioned, able to type something in the Q&A box, we're happy to respond to it. We'll wait here for a few minutes.
Okay, the question is the 145,000 limit on Roth in 2024 applicable to every dollar of earnings or just money above the 145?
So I think the question is relating to Roth IRA contributions, if I'm understanding correctly. So if that is the question, and please feel free to respond in the Q&A if I'm not answering this appropriately. So in order to make the contributions, your income for a single filer, you can make the maximum amount of contribution if your income is under $138,000, assuming you have either $6,500 of earnings under age 70, or if you want to make the maximum contribution of $7,500 by combining the catch-up and the traditional, you have to have $7,500 of earnings. If your income is above 138,000, it starts to fade out. So by the time you get to income of 153,000, you can't put anything into the IRA or the Roth IRA on an elective base, or for the Roth IRA, I'm sorry. And then likewise for married filing joint, the income thresholds are higher, but a similar process. I think that answered the question, but again, if that does not address the question, please feel free to put something in the Q&A box and we're happy to address.
And if it does address the, or pertain to the Secure 2.0 change where you
Oh,
limit, yeah, that blue box there. So yeah, I think if you make more than 150 in wages and you want to do any catch-up contributions, they have to be into the Roth 401k portion. You can still deduct up to that, but this is just for the catch-up contribution. Once you hit that amount, everything is considered into the Roth 401k for the catch-up.
any other questions? Okay, well, we appreciate you joining us. We hope we gave you some insights going into the new year. And again, welcome you to reach out to discuss anything that's applicable to you or of any further questions. And with that, we'll let you get back to enjoying your afternoon. And we look forward to speaking with you soon. Take care.
Thank you, everyone.